Sticking with one of the most beaten up sectors in the market, and that is banks. Joining us this morning, portfolio manager of the Oakmark Select Fund and the Oakmark Equity and Income Fund, Alex Fitch. Alex, great to have you back. Thanks for joining us.
Thanks for having me.
What do you make of how banks have been treated so far in earnings season?
Well, I think more broadly, investors have really internalized the lessons of 2008 and 2020, which is that banks meaningfully underperform in any economic downturn. And all the recession fears, I think a lot of investors are unwilling to own banks today. And the problem we have with that analysis is that it ignores the price that you're paying. If you look just before '08 or just before 2020, banks were trading at, the S&P 500 banks were trading at around 12 times earnings. And you fast forward to today, the S&P 500 banks are at around 7 times earnings. So the market's already discounting the banks by about the same amount as they typically underperform in a recession. That's not to say they can't go down in the recession, but it might mean very different things for the point-to-point returns from here.
Right. Are you sensing best value in regionals, in money centers, in wealth management, investment banking?
It's a mix. One of our largest holdings in the Oakmark Select Fund is a bank called First Citizens that bought Silicon Valley's assets out of receivership earlier this year. It's we think, excellent bank, very well managed. It doesn't get nearly the attention it deserves for its track record and its size, being a top 20 institution today. The stock's up more than 150% from the lows this spring. In our view, that's fully justified by the growth in the earnings power that we've seen since then. This company was going to earn around $70 per share before buying Silicon Valley. Now it's on pace to earn around $200 per share next year. At around $1,400 for the stock price, we're still paying just 7 times earnings. So it's companies like that, the large banks and some of the regionals, where we have faith in the deposit franchise and see a low multiple.
But, we were talking last hour with Anthony Noto of SoFi, and he was saying he still feels uneasy about the risks that a lot of these banks face as a result of rising rates. If the Fed goes even further in December, it's not necessarily priced in, but just the size and scope of the unrealized losses on the balance sheet and potential more deposit pressure we could see in some of these regionals if the Fed keeps raising.
Yeah, it makes the deposit franchise that much more important. Our view on banking has always been one of the most important competitive advantages you can have is a strong deposit franchise, where you want customers to be banking with you for a reason other than price. If you look at the really large banks today, they are incredibly diversified, commercial accounts, retail accounts, generally small sizes, FDIC insured. They're sticky franchises. That's why they were able to step in earlier this spring and actually provide a form of a bailout rather than being the ones that needed to be bailed out. And so the banks with the good deposit franchises, I think, we believe should be able to weather whatever storms come.
As for energy and oil, Alex, so many cool cross currents. Obviously, there's geopolitics. We're watching demand levels. There's some M&A activity in the space finally. What do you like?
Well, the space is interesting in general. You're by and large getting double-digit free cash flow yields at current prices. Most all of that's coming back to shareholders, and these are companies that are still growing their underlying businesses, high single digits or mid-single digit rates. That's an attractive all-in return, in our opinion. I think investors, a little bit like the banks, may have also learned the wrong lesson from recent history. You've had this 10, 15-year period where anytime there were supply problems in the market, growth from U.S. shale would bail us out. And you had this persistent growth in U.S. shale production. It's much more difficult for that to be the case today. The original growth drivers, the Eagle Ford and Bakken, they're both producing much less than they did at peak. The Permian's running into productivity issues. Private operators are running out of locations. And so you might not have that available supply that you had in the past. And it might mean very different things for how prices look over the next decade.